We've never earned more money in our lives. I've never felt poorer. He goes, every time we get $1 in our bank accounts, we spend it. He goes, I want you to go away, just have a look at our finances, look at our debt structure, and just tell me what I'm doing wrong. And I went away, came back to him and said, the reality is the tax man's your issue at the moment. And your debt structure is all wrong, where you're paying your mortgage. You're a small business owner. He's a professional. He has to pay top marginal tax for him as an individual, but he's paying the tax man half his money, and then he pays off his mortgage. And he's got his dream house. And I said, if we go away and structure your finance in a correct manner, you should be able to release 3 times the amount of cash back into you and your family, which is very powerful. I realise I'm speaking to a bunch of small business owners, and hopefully I can give you a nugget or two here that you can take away and then apply to you and your families to release some cash. So today what I'm going to talk about is 3 things. First of all, having a theoretical discussion on debt versus equity. The reason I'm telling you this is this will give you access to greater lending limits, better capital structure so that you're paying your interest off pre-tax, and then ultimately it'll result in greater returns of equity to you and your family. I'll give you a simple example of this in practice, and I'll talk about working with Glenclair Financial, who we help and how to work with us. Keynote, this is general advice only. If you want financial advice, you have to go and talk to your financial advisor or talk to your accountant. So a little bit about me. I've worked in corporate for a long time, was at Westpac, ran teams. I ran a pricing team of 18 at one stage, was then over at CBA in that mid-market space. And then my old boss went out on his own and had a crack, and I never thought about going out. And so I decided to follow him and have never looked back. Right, debt versus equity. So just think about when you went and started your business. Did you go to a bank and get a loan? Or did you go to your fools, friends and family, raise a bit of capital that way to start your business? And does it matter? Well, the ultimate answer is no, it has no actual impact on your cash flows. And Modigliani and Miller proved that in 1958. So that whatever your capital requirement is in your business, it has no impact on your cash flows. There's 7 key requirements, assumptions as part of that. One of the big ones is bankruptcy risk, and the other one is tax. So what that actually looks like in practice, here's 2 examples of 2 businesses. This one is 100% equity funded. So they've gone to fools, friends and family to raise the required assets of an equity of $1 million in the business. And this one has been debt funded by $1 million. And what you'll note is that just through capital structure, we have instantly added $300,000 of asset in. And that's, of course, because assuming a 30% tax rate. I know some businesses are 25%. If you're a professional, you're paying 47%. So this tax debt shield actually goes up to $470,000. So it starts to become really powerful. Obviously, I've put it in brackets. And how you calculate that is just the debt amount multiplied by your tax rate. And so what that looks like in when we start to get into the cash flows, we've got the exact same EBIT number, earnings before interest and tax of $100,000. We then service interest and then we pay tax. So that's the key assumptions. And one thing I'd like you to note is that if I suddenly have a business that has $70,000, I distribute it to me as an individual, I have to pay tax on that again. And then I go and try and buy a house. And you ask Craig what you'll get for $70,000. Not much. Yeah. You've got to pay all your expenses. Whereas over here, the reality is, assuming fully secured basis, at a 2 times ICR, you're looking at about $800,000 of borrowing capital, which you can then go and release and buy, do whatever you want with. Buy some shares, buy property, So it just, more what I'm trying to say is that you've had to put no money in, so $0 of actual capital from you has gone in, you've gone and borrowed it, and you've made $21,000. And the key there is that you're paying interest before tax. So that's just a little nugget, hopefully, for everyone. And I'll skip through to this slide and I'll come back to the previous slide. What that actually looks like in practice with this individual small business owner, they're paying tax. They're a professional. They have to bill in their individual names just because of the structure. But they have to pay $510,000 of tax. They then have to pay a mortgage payments of $460,000. And so their actual free cash into them and their family was $120,000. And then in this example, exact same debt, they're actually paying a higher interest amount. They're paying interest pre-tax, and they've just released 3 times the amount of cash back into them and their families. So very powerful when you start to look at it in that manner. And not only that, the difference between business lending and consumer lending is that most business lending will park there indefinitely. You could have that, you could come back in 30 years and that'll still be at $6 million. So all of that free cash can be spat to you and your family. And most business owners will say, well, why would I repay it? Like, it's a nice tax shield. The effective interest rate I'm paying is actually a lot less than that. And the way you transition to that is you'll set up a business loan, a limit, and as any cash comes in, so it will go against any non-deductible debt. And then as any payments in the business, interest, tax, talk to your accountant, of course, it will go against the new business limit. And so you have this recycling effect. So non-deductible debt, draw against the business limit, into deductible debt. And why do you do that? Greater lending limits, higher returns on your equity, and greater free cash flow to you and your families. Right, so Glenclair Financial, who are we, what do? We help businesses get better rates from their banks and better terms from their debt. I'm running one at the moment where the client's saying, I'm not as focused on rate, I'm actually very focused on terms. Yeah, key thing here, we won't represent you if we can't get you a better rate. So if I look at your debt stack and I say, look, you're on a fantastic rate, I can't beat that. Yeah, but usually I haven't encountered that where, well, there's maybe been once I have encountered that. So yeah, so a little bit where we specialise, business owners, anyone importing, exporting, property developers, anyone looking for working capital, hospitality clients with special needs, and anyone trying to buy a business, we're helping as well. And so just a couple of wins in each category. And what you'll note in each one is that there's significant savings for business owners. And the reason we're able to do that, we run banking tenders, we demand best rates, and you've got to deal with the best bankers. Hey.